All right, a very good morning to you wherever you're joining us from. Welcome to yet another webinar in this series that we are calling GT Conversations KA. It's a series of conversations that we are having in terms of just informing our customers and helping you make better financial decisions even as we go on and as we help you navigate this economic environment and the current macro environment that we are experiencing in the country. My name is Jimmy Mbogo, my handle at Jim Cario. You can also tag us at GT Bank Kenya. And my guest is Mwenga Elvis, and he will be taking us through a series of presentations, first of all, and sort of painting the picture for us and setting the stage for this conversation. You can tweet us directly. We're live on Zoom, we're live on YouTube. Send in all the questions that you may have regarding the conversation that we will be having today. But for now, ladies and gentlemen, allow me to welcome my guest, Mr. Elvis Mwenga, CPA Elvis Mwenga, to set the stage for us and help us get into this conversation. Elvis, good morning.
Morning, Jimmy. How
are you? Ready for our conversation today?
I am.
All right, go ahead. The stage is yours.
Yeah, so thanks for having me here on this important conversation. And maybe just to start off, I think, Jimmy, I don't know about you, but everyone, including myself, has been influenced in one way or the other by an SME. Mm-hmm. And I remember as early back when I was younger, my parents would go to Uganda. This is in the 90s, early 2000s.
Yeah.
And buy stuff because it was cheaper there, and then come sell it in Kenya to clients here, yeah? So mainly clothes, belts, shoes, and whatnot. And that money is what helped pay the bills at the end of the day. Despite having their different careers, they still felt the urge to start something of their own that would supplement their income.
Their income, yeah.
So, and the reality becomes, once you exit, even if you're in your career, you are biased, and we were discussing this before we went live.
Yeah.
What would you do if you were not
if you were in the career
that you're in? And I said I would be a farmer. I don't know. What did you say you would be?
I told you I would be a professional rugby player.
Yeah.
At least I thought I had talent.
And of course, the problem with sports is you have a small window. After, like in football, I see once you're over 30, then you're considered a depreciated asset, for lack of a better word. You're not as fast as you were when you were younger and whatnot. But anyway, not to digress, the point is SMEs are the lifeblood of our economy. Mm-hmm. But the statistics are actually quite worrying if you look at them. A half of registered companies in Kenya, and this is from KNBS, don't make it to their first birthday. That's 50%. Another 70% of the remaining die after 3 years.
Yeah.
And then if you think about businesses that are 10 years old and above, they're quite few. They're a handful. And what distinguishes these kinds of businesses is how they manage their finances. Mm-hmm. And that's what we'll talk about today. I'll set the stage for us. I'll discuss two main things. I'll be biased towards cash flow and access to finance. Mm-hmm. And then we'll take the conversation from there.
Absolutely.
So just jumping in, the first thing is to understand the cash reality for most SMEs at least in Kenya. And I think it should be the same globally. So most businesses do not distinguish between cash and profit. A lack of cash will kill you faster than being profitable. Mm-hmm. Now, I know I might be jumping the gun here, but there are three things that SMEs need to reconcile. That is one thing called revenue, the other is profit, and the other is cash. Mm-hmm. Now, revenue is when I offer or you offer a service and you invoice your client and you record that in your books. Unasema, I have done this. I have delivered on my end. I'm just waiting for payment. Mm-hmm. Then you have profit. Profit is all the sales you've made in the year less your expenditure, right? Yeah. And then cash is what you have in the bank. Now, the biggest challenge for most SMEs is reconciling the difference between profit and cash. Now, the lifeblood of any business is cash and cash flow, for that matter.
Yeah.
You pay your suppliers, you pay your employees, you pay for rent, electricity, all the attendant costs that come with running a business from cash. So the trap that most SMEs falling in is when you look at their books, they look very profitable because they've made the sale, yes, but has it materialized into cash? Yeah. And later on, we'll talk about something called the cash conversion cycle. But just to introduce that aspect of cash, which is a conundrum for many, is that cash will kill you faster than profits will.
What does that mean, Elvis?
Yeah.
Could you just explain slowly, for the sake of those of us who are trying to get into business, what does that mean?
Yeah. What that means is, as a business, you need to understand how money comes in and how the rate at which money goes out of your business.
Yeah.
Now, let me give a practical example just to make it, to sink it in, to land it. If I'm a business and I have made 5 million in sales this year, and then my profit is, say, 1 million shillings in the year. But when I look at my bank, I have 50,000 shillings. What do you think? Do you think my business will survive in the long term with such an arrangement?
That's interesting.
So you have 5 million in sales.
Yeah.
Remember, when you make a sale, you record it immediately in your books.
Mm-hmm.
We recognize it as income.
Yeah.
But the reality is you may have not collected that money.
Mm-hmm.
Yeah. So you have supplied Jimmy, you supplied Annette with some goods, but they have not paid you. And maybe you have an arrangement with the people you supply to, and you tell them, hey, within 90 days, I need my money.
Yeah.
So depending on the nature of your business, what we call the cash conversion cycle is basically starting from, think about it this way. When you start a business, you probably have cash. Let's say I'm selling this glass of water, or a glass for that matter. I go buy this glass for whatever amount of money. It becomes what we call in business my inventory. Mm-hmm. Yeah. Now that inventory is what I make a sale. I have a shop somewhere in Muturwa or whatever, and then I make a sale. People walk in, they buy glasses.
Yeah.
Once I make this, that sale can take two forms. People can pay me in cash, or I can give them on credit terms. Now, every business loves cash buyers for obvious reasons.
I mean, in business, cash is king.
Cash
at the
is
end
king,
of the day,
yeah. But the reality of business is that you need to have some credit terms, especially with your large clientele, people who give you regular business.
Yeah.
So when you go that route, then you introduce something called a receivable. Basically, people who owe you money are called receivables. Yeah.
Yeah.
So we've started with cash. We bought inventory. Then we went and sold that inventory on credit.
Yeah.
Then the next step is you need to collect that money, right? So this is what is codified as the cash conversion cycle. How all this money moves all the way from cash back to cash.
Yeah.
And the shorter the period is for a business, the better in terms of survival, especially for an SME. Mm-hmm. Because cash is the lifeblood of the business.
Yeah. So, Elvis, and it's a good thing that you bring that out, because one of the many questions that a lot of businesses struggle with is, and even those who are analyzing these businesses, one of the questions that maybe for entrepreneurs that they might not know, and SMEs, that something that I think you need to help us understand is, so what do I consider when I'm looking at my business to say that my business is either profitable or it's not?
So profitability is actually a very important marker in any business.
Yeah.
In fact, finance people, numbers don't lie. If you sit down with your business and you're not making a profit at the end of the day, you shouldn't be doing that business. It's as simple as that. And profit here, just to be clear, is two things. Profit can be top line, yeah, and that is your revenue less your cost of sales.
Yeah.
Cost of sales is anything that goes into if it's the glass. You bought the glass from someone, you incurred transport costs to bring it to your place of business. If you're packaging it in any way, anything that is going into that selling endeavor is your cost of sales. So you take your top line revenue, less your cost of sales, you arrive at something called a gross profit. Yeah. So that's the first number you need to look at as a business.
Yeah, which is your gross profit.
Gross profit, yeah. So this is the profit from the core business. The main business that you do.
You bought a glass for 10 shillings, you sold it for 15. The 5 shillings is your gross profit.
Is your gross profit, right? So that is the first number you need to look at. And it just, if you were to take, so 5 shillings is your gross profit, right? So if you wanted to, we normally have some ratios in finance that you look at.
Yeah.
So if you're to take the 5 shillings, which is your profit, and you divide it by your sales, which was 15, right? You sold it at 15.
Yeah.
Roughly that is around 5 divided by 3, so 33.3%.
Yeah.
So that becomes your, in percentage terms, what we call your gross margin, yeah? Now, a healthy business is, depending on the nature, again, unless you're in construction. Construction normally have very thin margins, but they move a lot of money. But for a normal SME, anything above 25% upwards, in fact 30, is considered healthy, a healthy gross margin, yeah? Then once you get that gross profit number, for us it's 5. You then ask yourself, what are my other expenses?
Yeah.
So I'm paying salaries. I'm paying maybe salaries of 1 shilling. I'm paying rent of another 1 shilling. I'm paying myself salaries. I include, and by the, maybe that's another anecdote for SMEs. The time that you spend as an SME owner, as an entrepreneur, should be compensated, and we should see that number in the books. You should pay yourself because you're offering a service to the business.
Yeah.
So once you take all that other expense, all those expenses, so let's say there are 3, for example, purposes. Our gross profit was 5, right? Minus 3, you get 2.
Yeah.
So 2 becomes what we call your net profit.
Your net profit, yeah.
Your net profit. So again, you can still do another ratio, your net profit over your 15, to just look at how your business is doing. And there are many other ratios that you can look at to just see the health of your business.
All right, so I want to bring you back to where we started this conversation, and it's a question of businesses being profitable on paper but cash starved. So if I'm running a business, I know that I have made all these sales, but clients have not paid. How do I ensure that I then continue to survive and continue operating?
Yeah, that's a very good question, actually, because the cash crunch, I personally believe, having observed many SMEs, including in my own parents and many other people around me, I think the reason most SMEs would fail is not because there's no demand for goods. It's not because, and nowadays with technology, with WhatsApp business, with Facebook, there's so many ways you can be client facing and make a sale in any given day. And of course, technology has allowed you to make sales across Kenya, if not globally, depending on what you're selling. So the reason then that you are revenue, your top line on paper, you are very profitable, but you don't seem to be collecting is, one, the fact that what is your debt? We have something we call debtor or receivable days in finance, which essentially tracks how long does it take you to collect money when you sell on credit. And there's a simple formula. You take all the money you're owed by your customers, you divide it by your credit sales in the year, times 365. The number you get is in days. So the shorter the period, you're good. So most SMEs have a longer period in terms of collecting money.
Is that a good thing or is it dangerous?
So for SMEs, I think it's a dangerous thing. Because for SMEs, you have not yet built up that that mature balance sheet that can support longer credit periods for your customers. So you need to shorten the time between supply and payment as much as possible.
Yeah.
Because remember, at the end of the day, salaries need to be paid, rent is due, and all these other requirements of the business will not wait for you.
Yeah.
Your landlord will probably come and put a padlock on your door if you're not paying your dues. So on paper, you need to first, or rather to answer your question, you need to first shorten those collectible days. Yeah. The other thing you need to look at is the fundamentals of your business. And we've walked through what you just asked me is what we call a profit and loss statement.
Yeah.
So you do not fix a cash problem by increasing revenues. And most people, I think, get that wrong. When business is slow and people are saying, hey, we need to increase revenue.
Yeah, we need to sell more.
We need to sell more. We need to sell more. The question first starts with, how are you pricing your product? How you're marking it up based on your cost? And then, more importantly, does your business, first of all, make sense on paper? And in Kenya, it's very easy to start a business based on emotions rather than business fundamentals.
Yeah.
So before you start any business, the most prudent thing to do is to do something called some simple financial modeling. You ask yourself, today if I start at point X, what will this business look like in 5 years? Will I still want to be in this business 2 years down the line? Because the truth is, and Jimmy, you can bear me witness, we have romanticized being an SME or starting a business for that matter. Many people, in fact, are told, leave your career, start a business.
Start a business, yeah.
It's a good thing. Not to say business is a bad thing, but have you counted the cost? You need to count the cost. You need to understand, what am I getting into? My mom is almost retiring in a few, and she's already planning. What would she do? And I'm always telling her, I'm always telling her, first understand, do your research. Don't just do business because it is now a survival. It is for you to survive. No, if you want to do business, do it properly, and that includes looking at your financial management and doing that modeling to be able to see what the future would possibly look like.
All right, so let's go back to this setup of this business and the idea of it. One of the things that, and I like that you brought this out, because then we've talked about how often businesses die, but we haven't talked about what is the average turnaround time for business to turn profitable? How much time do I need to put in the business on average, particularly for an SME? After how long should I start expecting my profits to come in?
For me, I think I stand by what I said earlier.
Yeah.
You shouldn't be getting into a business that is not profitable.
From the onset?
From the onset. Okay. When you sit down and do your mathematics fast, look at that profit and loss statement and forecast it. It should make business sense fast before you go buy any inventory. But of course, the realities of business are also true. On paper, it would make sense, yeah? It would have made sense.
Yeah.
But the reality is there are many other factors that come into play. Maybe you put your storefront in a place that is not very lucrative. So you do not, especially if your business is one that requires your inventory to move very quickly.
Yeah.
A quick example is, if you want to buy showers in Nairobi, shower heads, you go to Muturo, right? That is like the capital of electrical stuff. So many people go by there, not just single buyers like you and myself,
yeah,
but even wholesalers go there, buy in bulk, and then on sell in retail to other people. So the truth is, while on paper the business might make sense, there are many other factors that you need to put in place. How aggressive are you possibly marketing? Do you have an addressable market that you're possibly targeting with your product?
Yeah.
So all these factors would confound, but from a purely financial standpoint, if you're asking yourself, this is the capital that I'm injecting into this business.
Yeah.
It is possible to know from day one by projection where you want to be. And that what that does for you is not to predict the future per se, because we don't know what that looks like. But it makes you know, how much do I need to sell in a given month to meet my obligations? What are the possible areas that I can cut my costs on so that my business is profitable?
Remains afloat at the very least.
Exactly.
Yeah. So just to remind our audience that are joining in right now, whether it's on Zoom or on YouTube, we're live on both platforms. The conversation that we are having today is financial management for SMEs, looking at cash flow and access to finance. That is the focus of this conversation. It's part of a series of conversations that we have dubbed GT Conversations KE, that we will continue to help you grow your business. We'll be giving you solutions to your financial issues, and that is why we're having these conversations. Now, Elvis, let me take you back. There seems to be a trend or a tendency for a lot of businesses in Kenya to go the retail way. Buy something, sell it. We hardly talk about people who opt to go into the service business. I have a service that I know I can offer, so how do I treat that business? How do I ensure that once I put myself out there, that I attract enough clients, well-paying clients to keep me afloat?
Yeah.
And is retail for everyone?
That's a very good question. And I can start by an anecdote. Like any Kenyan, I've also tried business, my hand in business in one way or form or the other. One of the first businesses that I ever did was selling bricks, stones, za kujenga nyumba. These stones. You buy it at, I think that time it was going for 15 shillings, depending on the type of stone. And then you do a markup on that and you on sell.
Yeah.
It was a profitable business, but it was not, first of all, I was not there. I used to do it through a proxy who would buy, then go supply to a client or a site or a construction site. The beauty about that business is that it was a daily cash kind of business. So you'd receive your cash at the end of the day or reinvest it in the next truck. The next form of business I did, which burnt my fingers terribly, was buying and selling of maize. Used to buy maize either in Eldoret or Uganda, bring it into the country, then on-sell it to the millers. Then one day, I got a call after putting in some significant capital that the maize that we bought to on-sell has been rained on. As a matter of fact, some of it has started to germinate. So that's how I lost a good chunk of money that time. I remember going to bed and feeling my chest was a bit heavy because it was my first foray into business, fairly young. And what I learned from these two examples is that, first of all, is not to do a business that you are not practically and physically involved, especially when you're dealing in goods. You need to have people you can trust, if not yourself, running the business. You need to have in place internal controls that can ensure, and we've had many stories of people, errant employees who steal your stock and many other things. So that was my first foray. But to your question, what about service industry? I think service industry is one of the easiest businesses to start. Personally, my field is in accounting and financial advisory. So the beauty about the service industry is the upfront costs, if you think about it, are low. Jimmy is good at what he does. He's a journalist. I have a gig come do an MC gig, a podcast for me, I pay Jimmy his money, and Jimmy's good. If you think about the cost that Jimmy has incurred, is maybe bringing himself to this studio. And I hope GT is paying you, Jimmy.
I'm a friend of the bank.
They give you preferential rates on your loans. And that was a light note, but the upfront costs for service-oriented industry is very low.
Yeah.
But of course, when you think about it at scale now, of course, their costs start to increase. But if you purely think about it from, and there's another nice book called The Company of One that argues that perhaps growth is not for everyone. And I had a slide of that, and we'll get to it.
Yeah.
That's the other thing that SMEs probably get wrong. Wanting to grow before their time, before they're mature enough. They want to open branches everywhere. And they have not understand the fundamentals of finance, especially something called working capital.
Yeah.
So service industry is fantastic. I personally have a bias towards service industry.
Yeah.
But the truth is, the guys who sell physical goods also make a good amount of money, especially if you're there physically and you understand how your business works on a day-to-day.
All right, so do I hear you to say, Elvis, that before I start a business, one of the things that I need to do is invest in understanding the end-to-end operations of how this business is going to run, understand how the value chain works, and understand some of the risks that I'm likely to face. And why is that important?
It's crucial because it's for you. It's a matter, as an SME. It's a matter of life and death. Assuming you took a loan from GT, since they are hosts here, for five mics, and you go ban it tomorrow. GT are running a business, and you signed on the dotted line and said, I'll be paying this amount of money of principal and interest back every month. So it is crucial for businesses to understand that entire value chain, end to end. Understand, and one of the other wonderful books that I'd recommend for any entrepreneur that I was introduced to by one of my mentors is The Richest Man in Babylon. Small book, but one of the key lessons is that you do not give your money to a charcoal seller so that they can buy diamonds for you.
Yeah.
You need to, first of all, need to understand your business, and two, if you're using someone as is business, the nature of business is that you don't do it in isolation. There are many other partners that you work with along the line. Just know where you're putting your money. Trust the people that build the relationships. They're very important because they matter.
All right, and actually, speaking of some of the solutions that GT Bank has, so if you're a business operating in the country and you're looking for capital to expand your business, you're looking for working capital, you should consider one of the products that GT has, and that is GT Mazao. And particularly, if you are an SME operating in this market, we have fantastic products that maybe you need to consider, and we will be sharing those contacts in terms of who you can reach out to and get as much information as you can. So Elvis, let me bring you back to the setting up of this business before we go into the scaling up of the business. One of the things that a lot of SMEs struggle with is bookkeeping. So what are some of the structures that I need to build from the onset? Once I've set up the business, I've established, I'm going to get into the glass business, I'm going to be selling glass, and this is how I'm going to ensure that my inventory is accounted for. So what are some of the solutions that I need to look at in just once I get into that business? How do I get it right from the onset?
Yeah, I think that's a very important question. Most businesses run like, you remember back in the day, I remember when bread used to be like 20 shillings, and that gives out my age. When you'd go and take on credit so that your folks come and pay maybe in the evening.
Yeah.
The owner of the kiosk would have a book, and they would write, Elvis owes me 15 shillings, X owes me this. So as early as that, based on the kind of, because SMEs, we have micro SMEs as well, yeah? Asking a micro SME to have an Excel sheet somewhere might not cut it, yeah? So there are varied solutions for SMEs when it comes to bookkeeping.
Mm-hmm.
One is as simple as maintaining that simple record.
Yeah.
As long as you can trace your sales, as long as you know what your assets are, your liabilities are, and of course your expenses, you should be good to go.
Yeah.
Then the issue becomes, how does technology now nexus with that rudimentary kind of record keeping?
Mm-hmm.
The next form of business then, or SME, would rely on an Excel sheet. So you have an Excel sheet for your business. You know, this is how much inventory I have. When you sell inventory, you knock it off from that Excel sheet.
Yeah.
It's very manual. Although, if you find someone who knows how to work with Excel properly, they could automate it for you, so that your work is just to do the double entries, so that it still mimics a proper accounting bookkeeping system.
Yeah.
So Excel is very usable. Yeah.
All right. So I think the biggest concern that a lot of businesses will tell you is, I sold X number of glass drinking glasses to Elvis and this company and that company. That was last month. This month, I'm yet to get that payment. I've sold 50 pairs of glasses again to another company. So I'm more concerned about this payment that is coming. And to a certain degree, the longer that payment delays, the higher the chances are that I will forget to follow up on that payment. So what do I need to do to ensure that even as I'm making a record of my inventory and making sure that my sales are okay, how do I make sure that I'm not losing money because of not having proper records?
Yeah, and that takes me to the modern solutions now.
Yeah.
In the market, we have many players who have democratized accounting, bookkeeping systems. And we see them on billboards. And of course, I won't name them here, because I don't hold fort for them. But there are many solutions out there now. There's no excuse for any business. And of course, and there's a payment, of course. But I believe I've seen as little as 1,500 for 1,500 shillings a month.
Yeah.
You can get a simple, intuitive system that you can use for record keeping purposes.
Yeah.
The beauty about these automated systems is that they have embedded other aspects within. They auto-generate reports for you. For instance, what you're saying, you sold to Jimmy, and because you wrote it in a book somewhere, you forgot.
Yeah.
These systems are intuitive in the sense that they remind you. You can generate. So if I want to generate a report, who owes me money? I can generate that, and it breaks it down in terms of how long has this debt been outstanding. Then I go and follow up actively.
Yeah.
The other thing is they can send automated reminders to your people who owe you money, your debtors. This every so often you can say every 15 days or so, just remind Jimmy, send him an email, a text, saying, "Hey Jimmy, you owe me X amount of money. Please make good." So that kind of pressure to collect, and what I talked about earlier about your cash conversion cycle, is important, and these automated systems help you. The other beautiful thing I've seen with these automated systems is even marketing. Whenever you have a new product, whenever you are running a discount or anything, it can automatically send this kind of information to your client list. And that way, again, helps to improve your sales.
Yeah.
So automated systems are the way to go. They have been made cheaper. They've been democratized even more. And every SME in Kenya, regardless of size, needs to consider.
You need to make an effort to just automate your systems. So Elvis, again, from a financial standpoint, what are some of the most common mistakes that a lot of SMEs make, and especially in their initial setting up stage? When you look at the first 3 months to the first 1 year, what are some of those mistakes that maybe that could be saved, but because of lack of knowledge or maybe because of inexperience, then they end up making these financial mistakes?
Yeah. The most obvious one is not separating personal finances with business finances. And many SMEs are culprits when it comes to this.
Yeah. But I am the business, though.
You are the business, but you need to separate yourself from the business. And one of the biggest indicators of whether you'll succeed as a business is if Jimmy, for some reason, goes on vacation or fall sick tomorrow, will my business continue to run? So you need to think about your business as in fact, in legal terms,
Yeah.
once you register a business, it becomes a separate legal entity.
Yeah.
So it is considered a human being, in quotes, on its own. So one of them is, of course, businesses do not separate my cash versus cash for the business. So you end up using cash for the business to do your personal things.
Yeah.
And you're wondering why your business is not sustainable, because you are not treating your business seriously. I normally say quam to serious. If you're an SME, quam to serious. You need to have that distinction.
Yeah.
And this is not to say that that an SME owner shouldn't pay themselves. If they pay themselves, let it be under the salaries and wages. Let it be within the structures of the business. The same way they would pay any other employees, the same way they should treat themselves.
Yeah.
When it comes to payment. So that is the first thing I see people do wrong. The other thing I see from a cash perspective and a cash flow perspective is not understanding how that cash conversion cycle works. So you are recording, you're making sales, you're happy. You're moving goods, yeah. But at the end of the day, if you're not collecting, you will be stuck.
Yeah.
So most SMEs, as we mentioned earlier, get stuck because they do not have cash. And when they don't have cash, they have to borrow. You go to a bank, they try borrow to solve a crisis that is, you could argue, self-engineered because of not understanding this cash conversion cycle.
All right, and speaking about cash, one of the things that a lot of SMEs struggle with is access to capital. From where you sit, and as someone who speaks to a lot of SMEs, why do SMEs struggle to access capital? What is it about the way they keep their books that makes it hard for banks or financial institutions to trust them with huge sums of capital?
I could answer that by looking at, again, putting myself in the shoes of an SME in Kenya. So most SMEs in Kenya start from survival mode. I've just started a new business. I don't know how this thing will go, but I have hope. I have faith that this business will work out for me.
Yeah.
Then if they stick in there longer, they move to the control stage. This control stage is where now you've sort of gotten into the groove of how your business works. You understand your customers. You probably understand what are fast moving, what is slow moving in terms of inventory.
Yeah.
Then once you get control, you start thinking, okay, I think I'm ready to grow. So you expand either, and expansion can look like either increasing the number of items you sell or opening a new branch somewhere and whatnot. And then the final stage is what I call bankability. Can a bank look at you and say, this guy, I would give my money any day? So access to finance sits at that point of bankability. Is your business bankable? And one of the first things that banks would look at is, first, do you have audited okay, in Kenya actually, below a certain threshold, I think it's 5 million shillings, you're not required really to produce audited accounts. But when you want a facility with a bank, you definitely have to go with audited accounts.
Yeah. So, Elvis, again, in most cases, we look at what SMEs need to do to prepare to be or make themselves at least attractive to get some of these financial assistance from the bank or any other financial institution. But the question that we hardly ask is, what should I consider before determining which bank to go to? What are some of the things about this contract that I, as an SME business, need to look at first before saying, okay, I'm going to go to Elvis to get this amount?
Yeah, it's more like dating and marriage. First, you ask. I would still insist first to ask, am I the right person? Before I go to a bank, any bank for that matter. But still, building from who am I as a business? All banks, regardless of whether they are SME facing or not, would ask for what I talked about, financial statements, before they they come and give you money as Jimmy.
Yeah, which is more of a credibility question. Yeah.
It's a credibility question.
Yeah.
And there's something called the 5 C's of credit. One of them is character, for instance. Who is Jimmy? They get to know you, they interact with you, you have a relationship manager,
Yeah.
they walk with you that journey, they understand what do you do. Then the next step is they look at your books. What do the books say? The books say, Jimmy's business is profitable. And look at the profit and loss statement.
Yeah.
Jimmy is making money. The business makes sense. But most banks actually default to looking at something called the balance sheet. And the balance sheet, simply put, I was trying to come up with an intuitive way to distinguish between a profit and loss statement and a balance sheet.
Yeah.
So think about it as the profit and loss statement is about speed. How fast is my business making money? At what rate are we making profit? And that speaks to what we talked about, the margins that you could compute. And maybe the next episode we could consider those ratios.
Yeah.
And then the balance sheet is about distance. How long can this business travel? That's why you hear people say, how strong is your balance sheet? And the balance sheet basically is all the assets of the business and all the liabilities of the business. Yeah. So when you look at the balance sheet of any business,
Yeah.
it tells you sort of how it could give you an indication on how long Jimmy would be able to survive if they stopped business today.
Yeah.
If they were to liquidate everything on that balance sheet, how long would the business last? So while the profit and loss is the day-to-day sales
Yeah.
expenses, the balance sheet is a snapshot at a point in time. And that's why you find most balance sheets are as at year end, 31st December 2025.
Yeah.
So they give you a snapshot at a given point on the health of the business. So a bank would come, look at these two statements, ask themselves, is this a bankable business? And then more importantly, they would also look at something called the cash flow statement.
Yeah.
And I had an image, maybe I should, I can go to that quickly.
Yeah.
Just to show the differences between those three statements. And Jimmy, actually, it's a fun fact that most businesses cannot tell you the difference between a profit and loss statement and a balance sheet. Most business owners. So it also speaks to what I call what we're doing here. And GT is doing a great job in terms of just financial literacy.
Yeah.
Because remember, it does not make sense for a bank like GT to lend to people who do not know how to work with the money they've been given. That's why we're doing this whole series podcast.
Yeah.
So this image here, right here, and I hope the audience is also following us as we go, is the three statements that I'm talking about. A profit and loss statement, a balance sheet, and a cash flow statement.
Yeah.
So a bank like GT would come, look at this, compute a few ratios to just see what is the health of this business. Is it a bankable business? Numbers don't lie. And so there's so many kinds of businesses you'll find. You'll find a business that has a strong balance sheet, but is cash strapped. As a bank, I'd be worried. I'd be iffy about lending money to you.
Yeah.
When it comes to access to finance, because it shows me you'll not be able to meet my monthly requirements of interest, principal, and interest repayments. The other thing they look at, of course, and this one is obvious, is the profit and loss statement. And again, you can have a very strong P&L working for you.
Yeah.
And remember, Jimmy, we said your revenue can be big up there, but if you're not collecting, it is not translating into cash.
Into cash, yeah.
And that's why you have this cash flow statement. It just shows you, if I isolate all the noise in the business in terms of three segments, operating, investing, and financing, if I remove all this and isolate it into those three things, does this business make sense?
All right. And I think just even as we look at some of these different balance sheet, different books, one of the things that I want to just remind our audience is the fact that if you are in business and you have invoices and maybe your clients haven't paid, then you're in the right platform, because GT Bank has its invoice discounting facility, which then allows you to be able to continue with your business even as you wait for that payment to be made good, or for that payment to come. And particularly, again, this is tailored for SMEs, it's tailored for large scale businesses, and it doesn't matter where you operate. As long as you operate within Kenya particularly, you can just walk into any GT bank and speak to your branch manager or your relationship manager, and they will be able to help you and ensure that whatever facility it is that you're looking at, they will be able to fund it, and then they will give you that they will be able to take that headache away from you, and just making sure that your business remains afloat. Now, I can see our time is well spent, and now I want to invite all of you who are following this conversation, if you have any question related to this conversation that we are having, just to remind you again, the topic that we are looking at is financial management for SMEs, cash flow, and access to finance. We've talked about cash flow. We know the headaches that you deal with, particularly delayed payments that might or should be coming your way that have taken longer than they should. Again, we have these facilities to be able to address some of these headaches. Now, Elvis, and as we allow our audience to continue interacting with these books of account, the one thing that a lot of us who have tried business have either struggled with or have tried to make that decision, or have had a hard time in making that decision, is the question around two things: diversification and expansion. When do I know it's time for me to scale up my business, or when do I know it's time for me to diversify? What do I need to look at?
Well, that is perhaps one of the toughest questions you could ever ask anyone.
Yeah.
Including governments, including our government. Mm-hmm. But it maybe to just take a step back. One of the greatest economists is a man called Joseph. He's found in the Bible. And there's a time he had a dream, mm-hmm. and he said the king had a dream, and he was told to go interpret. So, for those who read the good book, there was 7 years of drought.
Yeah.
But rather 7 years of prosperity, followed by 7 years of drought. Yeah, and he was shown 7 fat cows, and then 7 thin ones, and many other variations around the same. And he was told to interpret this to the king. Now, I call him the first economist, and he's a classical economist for that matter, mm-hmm. because he codified what we now understand as the business cycle. So, intuitively, and this is like the laws of nature now, the business cycle moves with 7 years, almost between 5 to 7 years, where everything is going very well. Then you have another 7 years of things going very bad. And then the business cycle picks up again. This is how, even if you look at stock markets, they move up, down, up, down. It's like a heartbeat of sorts. So at a macro level, at a country level, when the National Treasury sits down and comes up with policy, the business cycle should be one of the things that we should be looking at front and center. Because if you understand that this is how the business cycle moves, you know when it's time of prosperity, the immediate response mm-hmm. of many is, hey, we have money. Let's build roads. And I have nothing against roads. And this is not a political podcast. I think roads are fantastic because they open up the infrastructure. But the thing is, how do you plan in such a way that when you're doing very well, you also plan for the winter season? Yeah. That will most surely come.
Saving for
as soon as sure as the day, there will come a time in your business when things will be slow. Mm-hmm. It's just how business works. So SME owners, now coming to the micro level, at SME level when you're running your business, mm-hmm. at what point do you expand? Borrowing the same concept. you should practice cautious expansion. Again, this might not hold for all businesses.
Yeah.
The businesses where you need to move quickly, especially when it's a new nascent product and there's competition. So depending on the nature of your business, this might not hold true in all cases. But any form of expansion should be guided by these three statements. Again, that's why they're very fundamental.
Yeah.
That's why everyone needs to understand them. Because when you go into these financial statements, you can compute ratios. And one of the ratios that can help you, and maybe our audience can go check this out, is something called return on investment, where you take your capital, all the capital you've invested in the business, and work out that ratio to just see. And the baseline that most people use is if, for instance, Jimmy, you had 1 million shillings today, and you're given the option to start a business or to expand, versus to put it in a treasury bond. That's considered like the baseline. Right now, I know that T-bills and bonds are giving you, let's talk about the bonds.
Yeah.
They're giving you maybe 10, 11%, at the moment.
Thereabout.
So this rate of return is what you would compute in your business, the rate of return that your business will give you. The first thing to look at is to compare these two ratios and ask yourself, if this ratio that I'm computing in my business is lower than the risk-free rate, which is a treasury bond, then I shouldn't be expanding, because I would be destroying value. I would be putting money into expansion, but that expansion will not make money for me. So that's the first thing that a business can look at when they're thinking about expansion. The other thing is the business fundamentals. It's not just a matter of starting another branch in another place. It's a matter of, at the moment, have you gained the maturity as a business to be able to handle, let's say, a supermarket? I see one supermarket close to my home is Jaza. Jaza actually made history and opened, I think, was it 10 branches at a go on one day. The question is, do you understand? Have you done this business for a good time so that you understand how you can replicate it elsewhere? And replication is not just a matter of making profit. Replication is also a matter of, do you have internal controls in place? If you're running a supermarket, for instance, people can steal from you. Do you have inventory controls? Have you invested in cameras and whatnot and security systems? Do you have employees, the right employees to help you in your expansion journey? So sometimes I would see why businesses want to expand. Of course, it's to increase their money. But at the end of the day, and their profit for that matter, but at the end of the day, you need to really ask yourself, do the numbers support expansion?
This expansion,
And again, there are many ways to fund your expansion journey. You can go to a bank, get working capital financing. But before you go to a bank, the fundamentals of the business, are they there?
And if you're looking to go to a bank, you have one right here, GT Bank, is the place to go to. I mean, we've just talked to you about GT Mazao, which will help you get that working capital, will finance, particularly those in the SME space. But also, not just that, if you're a GT Bank client and you interact with a lot of SME owners and SME businesses, you absolutely have no reason to keep their money with you, because at the end of the day, we have GT Bank's gaps. This is in my opinion, an undisputed best way of making payments. It is a secure, web-based platform designed for business, both whether you're managing, whether you're just managing your salaries and paying salaries to your customers, you're managing payroll, you're looking at bulk transactions, we have you sorted. So this is one of the solutions that you really, really need to explore. And we have the contacts right there on the screen. Make sure you can reach out to any of our GT Bank staff and they will be able to guide you and give you the solution. Even when you're paying your taxes, you can use GT Bank's gaps. It's a wonderful, wonderful solution that you definitely need to keep checking. But Elvis, carry on.
Yeah. So what I was emphasizing there is you need to control before you grow.
Yeah.
You need to first manage your monthly numbers, like on the slides there. You need to build before you borrow. Again, asking for financing and access to finance is really much like dating.
Yeah.
You need to be a good person before you go. And of course, there have been many metaphors in Nairobi.
Yeah.
The streets of Nairobi, where people have been shown dust.
Yeah. So let me bring you back to that, to the options for financing. So when I'm looking to scale, or when I'm looking to expand my operation, one of the questions that comes to mind is, so do I go for debt financing? Do I get equity financing? What are my options? And why should the different options then, why should the option that I decide to go on, what are some of the things that I need to make sure that the option that I opt for then eventually strengthens my business?
So depending on where your business is at, if you're just starting out, you are probably injecting capital first. Most businesses, most SMEs would, probably have someone who had been saving for a while. That's the capital they're injecting to the business, or they fundraise within their circles, their relatives, their siblings to start a business. That's the first port of entry for any SME. Then once the SME has grown enough and has proof of concept, then this SME can now think, okay, now and the beauty about banking is that you create a record. If you're banking, let's say with GT, is GT can have sight of your transactions as a business, and they can see they can already start assessing your credit worthiness the more you transact with your bank.
With them, yeah.
So building that continual transaction, and most people actually, Jimmy, want to get a loan from a bank when things are thick. You should instead build a relationship with your bank, so that by the time you are coming to ask for a loan, in fact, build a relationship when things are so good. Because one day you'll anticipate that I will want money from GT.
Yeah.
So start building a relationship, and banks have made it easier now. They have a relationship manager. I have a relationship manager, and I don't run a business with my bank.
Yeah.
I won't mention the bank because
I hope it's GT. Definitely, it has to be GT. But continue. So, Elvis, and I hear you on that. But the concern that a lot of businesses have, and especially here in Kenya, is people are very risk averse, and particularly the risk of credit. A lot of businesses would want to operate their business from a cash funding perspective. They do not. They go for credit as a last minute solution. Is that a good thing, or is that skepticism founded, or do we need to be able to interact with banks to build that good credit, that you'll go and get credit today, you will do the business with the funds that you get from the bank, and you will be able to repay because the business is still operating optimally?
Yeah. So again, it goes back to the maturity of the business, really. I wouldn't advise a new business just started out the other day to come to a bank to borrow, for that matter, because one, you're still a lot to learn. You have not understood how your business works and how you'd be able to repay any form of debt, for that matter, even if it's not bank debt. But what I'm saying is, once you get a grips of how the business is working, then come to a bank. And there's nothing wrong with taking debt financing from a bank. I think any form of business, especially if growth is one of your things that you're looking at, at some point you will need debt. At some point, capital, you will need capital to expand. So the skepticism around whether to take debt or not, I think, is unfounded, because as long as your business fundamentals are making sense, you should be able to pay up your principal and interest. And many entities have gone to the market. Think about Safaricom did a green bond the other day. Think about EABL. I've been to the market for debt. KMRC have now done a bond in the market. While those are big entities, it just shows you that using that concept of using other people's money is very important. Yeah, when you're running a business.
And I can tell you, I mean, from a GT perspective, we don't mind you using our money as long as you pay it back. So you can always come and we can have that discussion. But let me bring you back to a different aspect of this conversation. Yeah. And one of those things that I want you to help a lot of our businesses understand. Does having insurance on my business improve my credit worthiness?
Having insurance on my business.
Yes.
It definitely it reduces the risk. Most SMEs are considered high risk in Kenya. One, because most of them are unbanked. That's the first thing. They do not have a trace. Nobody knows whether these guys exist or not.
Yeah.
Hence the discussions around KRA and informality. But the thing is, insurance does play a very important role in de-risking your business. What kind of insurance should you take? It depends on your business again.
Yeah.
If you have assets, you probably have insurance on your properties, and these are the things that banks would essentially ask as collateral when you're coming to take a loan. So if you have collateral and the collateral is insured, even better. It means it improves your credit rating. And by the way, banks do not treat all clients the same. People need to know this, because it would be unfair, first of all. If Jimmy has a proper business that has proper fundamentals and is insured, and has all these things working out for them, Jimmy should confidently walk into GT Bank and get a lower rate than me, who is just starting out. But I know GT also has products for those people. But what I'm trying to paint a picture here is the better you are at de-risking your business through insurance and other kind of products and operational tweaks, then you become bankable. You become extremely attractive for a bank. All
right. And again, and I think that's a good place to remind our audience that, of course, we have also an insurance premium financing. This is GT's way of making sure that your business is secure. It's making sure that we take that burden of you making that one lump sum payment to that insurance or that underwriter by giving you an extended period where you will be able to ensure that, again, you manage your cash flow well by not using, instead of paying 100,000, you can pay 20,000 for your premiums, and you can make sure that these smaller amounts are paid over a period of time, but at the same time, your business continues to preserve that much needed capital. Remember, when we started this conversation, one of the things that we said is cash is king for any business. Now, Elvis, let's move this conversation forward. And I have a question here that is being posed to us, which is, how should SMEs determine, and I think that you've addressed how debt financing is right, and then what financial documents should SMEs prepare when seeking credit?
Yeah. So this one is quite easy.
Yeah.
Because it goes back to those three statements that I just showed. So maybe a step back. Financial statements have, I would say, 5 things that every SME needs to ensure are within that financial statement. The first thing is the 3 statements that I've shown: the profit and loss, the balance sheet, and the statement of cash flow.
Yeah.
The 4th statement is known as a statement of changes in equity, which is it just shows you how the capital that has been injected into the business and how profit is moving in and out of the business, and loss for that matter. Then you have notes. There are things called notes that help you understand the basis of the numbers that you see up there. It basically goes down to breakdown. If you have, for instance, receivables, it shows you Jimmy owes me X, Elvis owes me X. It sort of just gives you more information about what you see in those primary statements. So that is what constitutes a full deck of financial statements. And it's also at this point that I also mentioned that financial statements are, there's rules to how you prepare them. For SMEs, or rather for everyone, regardless of whether you're an SME big business.
Yeah.
We have things called financial reporting standards. International, they're called IFRS, International Financial Reporting Standards. So whether you go to New York, whether you're an SME in New York or Colombia, that banned Africans the other day, the same set of information, you can easily compare an SME in Kenya to one in New York. So these rules have been developed over many years, and they continue to be developed.
Yeah.
For the big boys, the big businesses, they use something called full IFRS, which is a very big, complex standard that is not very user-friendly for SMEs.
Yeah.
But for SMEs, there was built another standard. It's called IFRS for SMEs. Now, this is the framework that houses all these primary financial statements and the notes to the financial statements.
Yeah.
It's the playbook, essentially. So my first call to action for SMEs, understand, and this is something you can easily Google and read through. They're bulky, but yes, they would help you to think through how you post and keep your books, post transactions and keep your books.
Yeah.
So this framework we developed, ISPAC is where I work, is financial accountancy bodies and standard setter. We regulate the accountancy profession.
Yeah.
And we are constantly trying to see how do we, for lack of a better word, simplify the complex language that is financial statements and make it palatable for SMEs. Because these statements are what SMEs would need to take to GT to get any form of finance. These statements are what any logical investor would first look at before they think about giving you a chance. So,
and actually, allow me to jump in here because we have a question of how often should SMEs review their financial performance?
So, from a cash perspective, it's weekly. You need to know how your cash is moving. Monthly, definitely. You need to also look at a few metrics within your business.
Yeah.
And of course, annually as you do your planning. But for SMEs, given the cash nature of your business, a weekly kind of analysis, and more importantly, doing something called a cash forecast. Don't wait to have a cash crunch. Don't wait to have a cash crunch so that you can work backwards and see how you will be able to sort it out.
Yeah.
So that's why you need to do a weekly sort of reconciliation.
Okay.
Yeah.
There's another question here that says, imagine you're speaking to a business owner who wants to double their revenue over the next 3 years. What financial management practices should they put in place today to ensure growth translates into sustainable cash flow and easier access to finance?
Double it in 3 years.
Yeah.
That's interesting. So, goes back to the fundamentals again. I think we have complicated finance for SMEs for a very long time. SMEs just need to understand first those 3 primary statements and how they work for their business.
Yeah.
The other thing I would advise is the cash conversion cycle.
Yeah.
Understand how long it takes for you to move from cash to inventory to sales to back to cash. That way,
because I actually think there's a lot of interest that is coming from that, and I think we have a question from Annette. I know we have an Annette, and I don't think this is from her, but even if it were, it's okay. She'll get a bit of information. And this is a question around if an SME owner could monitor only 3 financial indicators every month, which would you recommend and why?
Which 3?
Yeah. If they could monitor only 3 financial indicators every month, which 3 would you recommend and why?
I would go for accounts receivable, which is how much of your money is seated outside. How much do people owe you? That is a number I would look closely at because remember, I'm running a cash-rich business.
Yeah.
I need to collect quickly. So that is one number I'm always looking at. The other number I'm probably looking at is, do I have money in the bank? What is my cash balance? cash balance seems very intuitive if you think about it, because if you earn a salary every month, the moment your salary gets in, you pay your bills, you remain with X amount for enjoyment, for investment, for others would argue invest first, but that's not my point. My point is, for an SME, the cash balance is important because it tells you how much leg room you have within the month to possibly add more inventory, to pay off a few suppliers. So that is important. The other thing I'm looking at is my payables. Payables is what I owe other people. If I owe Jimmy 10 mics, I want to go to Jimmy, ask Jimmy for favorable payment period, because business is about relationship. So I don't want to frustrate my suppliers, especially my co-suppliers who are key to how my business runs. So I'm looking at that payables number, and I am slowly putting in place, based on my cash flow forecast, I'm slowly but surely ensuring I'm paying everyone, at least the core people, every month without fail, so that my business does not fail.
All right. And the third one?
Those are my three. I said cash,
yes,
receivables, and payables. Those are my three
key
numbers
ones
that I'm looking at monthly.
All right. So how should business facing temporary cash shortage handle that? What action would you prioritize in the first 30 to 90 days?
Cash shortage.
Yeah.
So cash, when you talk about cash, then you're talking about collection. Goes back to collection. So it means you're not collecting. That could be one of the reasons why you do not have cash. You have supplied goods, you've invoiced, your P&L shows that you're making profit, but you're not collecting. So the first thing is, what is the list of all my debtors who owe me? I need to start reminding them, hey, guys, I need to survive.
I need this payment to come through.
Yes, I need this payment to come through. I can even build in incentives. If you pay me within this period, then I'm happy to give you a small discount. So that for an SME, I cannot overemphasize why cash is very key. Then the other thing I am doing is looking at my operating expenditure. I'm asking myself, what are some extremes, or what are some of the areas that I can cut expenditure on? Most people go for employees. And I want to say that might not be the most prudent place to cut your expenditure on. So what are some of the excesses that you have in your business that you could possibly see how to reduce on? The other thing is, do you offer things like after-sales services? You know, these things, if you've not costed them in your business, they become a cost for you. So you've told, hey, if I sell you this thing, I will be servicing it every so often on free of charge. So have you costed that in your business? If not, that is one of the areas that is eating your cash up. The other thing I can think about, Jimmy, if between 30 to 90 days, is I'm starting to have honest conversations with my people I owe money. I'm telling them, hey, things are tight. And by the way, things are tight in the economy currently. For the SMEs that I've interacted with, in the past few, in fact, as late as yesterday, hey, they're telling me there's been payment delays. There's just been this cash crunch across the economy, and you can feel it across all the SMEs. So communicating with the people you owe money is very important. Because, again, you don't want your services to stop, especially if they are very important for the nature of your business. Communicate, over-communicate even with your key suppliers. And then maybe one more thing I could think about within 30 to 90 days. I'm probably going to my bank, asking them for a working capital facility, just to help me sail through this rough patch. Remember, it's not that my business is not making sense, it's that I have not collected. And sometimes collection is not even a matter of my clients not wanting to pay me. It is at the macro level, at the economics level. If there's a cash crunch in the entire economy, then
then it kind of slows things down.
Yeah.
And just in relation to that, and particularly talking about, and I know earlier on we mentioned about some of the working capital solutions that we have here at GT Bank, but also there's a question of, is overstocking guaranteeing supply, or is it merely parking capital in, and is that dangerous for small businesses or not?
Extremely dangerous. Especially for small businesses, you do not want to tie up too much of your stock, money in stock.
Yeah, so what ratio should I look at in terms of how much stock do I have and how much capital do I have?
There's no rule of thumb when it comes to inventory.
Yeah.
It's very business specific, because inventory is driven by your demand, by how much your customers need. So if Jimmy orders 50 from me, Annette orders 10 from me, and I can see this consistently month on month, then that data should tell me how much inventory I need to hold at any given point in time. Yeah. The businesses that, however, anticipate demand and want to have more stock on hand so that they do not have stock outs when their clients are asking for the products. Mm-hmm. I think there's still ways of maneuvering that without necessarily tying up your cash.
Yeah.
In fact, if you can manage your business in such a way that you have as minimal inventory, and there's formulas, business formulas to this.
Yeah.
Things called economic order quantity and minimum stock levels that you should maintain as a business. Mm-hmm. If you can maintain proper records and be able to forecast that, then you shouldn't have a challenge in terms of maintaining the minimum amount of stock you need at any given point.
Yeah.
But on the flip side, if you operate on gut feel, is that you will end up having so many of your inventory becoming obsolete, even depending on the nature of your business, if you overstock.
Yeah.
I have near my place where I go to buy vegetables. The guys who sell vegetables to me have been expanding. Actually, they actually just expanded. They're one of the SMEs that expanded, that I know. And it's because they've had very good uptake and they are located in a very strategic place. Mm-hmm. So I was asking them, so what happens, and especially for vegetables, if you bought tomatoes as a business, those things can get bad. I mean, if you don't sell stock today, and tomorrow, probably.
The shelf life is very limited. And actually, that also brings me to another question that I wanted to know. So, should there be a difference in terms of how much stock I keep for someone who's operating in FMCG space and for someone maybe operating in furniture?
Definitely. For FMCG, fast-moving consumer goods.
Yeah.
Definitely now there it's like the example of my vegetables people, especially if your location is perfect, then there's footfall, there's demand, people are buying because people still need to eat.
Yeah.
So your level of stock then is probably on a daily basis. You're probably restocking on a daily, depending on the item. But on the flip side, if you're a furniture maker, first of all, it takes you time to make the furniture. Mm-hmm. But you do not have enough space to store. Or if you were to make 10 pieces of furniture, you probably don't have enough space to store all of that. Mm-hmm. And secondly, the sales what do you call it, period between you making that piece of furniture and selling it can be quite long.
Yeah.
So you need to know how long does it take for me to sell. That again would indicate how much of this you should have. Okay.
Yeah. So there's a question here that comes from, I think this is, I wish they had given us their name, who's asking, when is the right time to borrow a loan as an SME? And there's another question that I think this goes to GT Bank. Does GT offer a lock savings account? So for a savings account, we'll definitely reach out to any of the contacts and any of the contacts that we've provided from the bank side, and we'll be able to guide you in terms of what your financial needs are, and we'll get someone to work with you and just give you all the options so that you make that decision knowing that this is the best decision I could make. So for that question, we'll be getting back to you. The numbers are on your screen, so please do kindly reach out to us and we'll be giving you those details. But Elvis, I think you can take this, and I think you had earlier on touched on it, which is when is the right time to borrow a loan as an SME?
Yeah. Yeah, for me, it's very clear. It's when you're mature enough.
Yeah.
When you have control over the business, and now you're almost at that point where you want to grow, whether it's through diversification, whether it's through expansion. This is the right time to start having conversations with your banker. But even before that, my principle has been finance, accounting, money is all about relationship.
Yeah.
Even before you need it. Otherwise you'll treat a bank as a okay, they have ATMs. Normally people say that sometimes relationships can be very extractive. You only come to me when you want something. But I guess that's how banks work anyway. But the point is, when you have a relationship with your bank, whoever is offering access to finance to you, conversations need to start when things are going well. In fact, if the vision of the business, the bigger vision is to expand and to be a global or even a well-known business, then financing is definitely something that is in your 5-year, 10-year plan as a business. So you can't escape the money debate, and the best way to start the money debate is by relationship.
All right. So just to go back to our viewer and our listener who has been following this conversation, and you were asking about a lock savings account. Yes, the answer is absolutely yes, that we have various saving options. And as I had earlier mentioned, just reach out to any of the numbers, the contacts that have been provided at the bottom corner of your screen, and we'll be able to get back to you and just share with you some of this information. And also, for those who might be following this conversation and maybe you are in need of an overdraft facility, there we have also solutions for you. All you need to do is show security, cash flow, board resolution, just the usual KYC document, that is know your customers, for directors, to ensure that even as we move on with you, even as we get it onto this engagement, we are able to help you, knowing who exactly you are. And remember, the currency of this, the financial market and the financial system, is accountability. So we need to be able to also just prove to our board that yes, we met Elvis and these are the documents that Elvis provided, and this is why we gave him this facility. So all these solutions, again, if you are in need of any of them, please do reach out to the contacts that we have provided at the bottom of the screen. We'll be reaching out to you, and we'll be walking this financial journey with you. So whether you're looking for an overdraft facility, you're looking for working capital facility, you're looking for an easier way of just being able to pay for your insurance premiums, all these facilities are there. And even for you who has to make payments across different platforms and across the different countries, we will be able to give you that solution. So do keep it here. And there's some of the benefits of being a GT customer. I hope we'll convert you to open another account and another one and a business one when the time comes, and maybe you can just be so that we also just continue to speak to these customers. But Elvis, there's a question around, again, and I want to take you back to the beginning of this conversation when we were talking about how often these businesses collapse and how often these businesses fold. When you look at the data, 70% of SMEs folding within the first 3 years. Why? Is it that we opened the business too soon? Is it that we opened the business unprepared? Is it that we couldn't get enough capital to keep the business going?
Yeah, it's a confounding of all those things, really. But for me, I think the most important in business, timing is crucial. There are times that when you get into the market, despite all the good intentions of having a profitable business, you just got in at the wrong time. You could also argue, but for me, I find increasingly that for SMEs, that cash crunch is what kills them. Because I mean, how many SMEs, for instance, do you as Jimmy support? Many. If you think about it, you're always buying something. Between now and the time you get back to your house in the evening, you probably have purchased many things, and all those people in that value chain are SMEs. So SMEs are getting your money. That's their revenue. But the problem becomes then, are they collecting it from Jimmy? How fast are they collecting it from Jimmy? And again, how are they using that money? So most SMEs are stuck in between a cash crunch most of the time because they're not able to do this kind of forecasting where they ask themselves, how much do I need this month, 2 months down the line, 3 months down the line? And there's, on the other side, SMEs that are ambitious for growth, over ambitious for growth. They want to expand without really understanding the fundamentals of their business.
Yeah.
And so again, the business ends up failing. You could also argue that businesses, the informal nature of businesses, especially SMEs, is something that many think is an advantage, but also is a disadvantage. Informality is good only to the extent that you don't get to pay taxes. But now, where the tax regime in the country is moving to, everyone is asking for an
e-TIMS invoice, yeah.
Yeah. I go to fuel my car, give me an e-TIMS.
Yeah.
Because I know at the end of 2026 period, then KRA will be on my back asking me, how did you spend X, Y, you know?
Yeah.
So we're moving into a space where informality has stopped becoming an advantage. And for those that are formal, the SMEs that are formal, one of the things that I normally look and laugh at is sometimes, especially if you're registered for VAT and pay as an SME, sometimes the cash crunch can bite. And you know, the first thing that is sacrificed is paying of taxes. So you delay paying your pay, you delay paying your VAT.
Yeah.
So that is not a very proper business setup if you think about it.
Yeah.
When you put VAT on an invoice, that is not your money. Everything above that is your money.
Yeah.
So plan with what is above. Give to Caesar what belongs to Caesar.
Belongs to Caesar.
So VAT in and of itself is not your money, and you should never plan with it.
All right. So and Elvis, one of the things that has clearly been very evident throughout this conversation is the fact that you could make sales, but you don't have the cash in hand because either the payments have delayed or you have not been able to collect. And the question that we really want to understand, even as we bring this conversation to a close, is what payment terms work best for SMEs dealing with even bigger corporates or SMEs that are in the supply chain?
So if an SME and you're supplying to a well-established corporate, normally I see most do 30 days. At least within 30 days, you're assured that if you supply to me, then I would have paid back.
Yeah.
Which is okay because at least they're established. But for smaller, medium, and SME, if
For
you're
those
doing
that are
any
starting
B2B,
off,
any B2B kind of transactions, if you can pay me cash now, it'd be great. It'd be fantastic. So again, it goes back to trust, relationship. If Jimmy is someone I've worked with for a while and his word is true, then I can see how to increase their payment terms and make them a bit flexible, so that of course we don't lose the relationship. But case by case. But for SMEs and many, it's a cash business.
Okay.
It's a cash business.
All right. So would you believe it? Actually, we've come to the end of this conversation. So
That's
I'd like to give you the opportunity to just make your closing remarks before we wrap it up.
Okay. Closing remarks, yeah. So I think mine is to just encourage SMEs. I think that the lifeblood, as I said, for our economy, they employ, I think, 8 million people from the recent statistics that were shown. So SMEs are here to stay. But SMEs don't need to die before their time. So it's very crucial that SMEs are given the right tools.
Speak to them directly. There's a camera right in front of you. Just talk to them and tell them exactly what you want them to do.
So if you're an SME and you're listening to us today and you followed our discussions, it's important that you log into some of these kinds of talks, because, and I want to give props to GT for organizing this, because I think information, that knowledge gap needs to be closed for SMEs to really achieve their objectives. The other thing is cash is king. Run your business with that in mind. The sooner you collect, the sooner you buy more inventory, the sooner you make more sales, and that's how you grow as a business. And finally, since I am biased towards the accounting profession, please consider using the IFRS for SME framework. especially if you will be approaching a bank like GT to give you a facility.
Yeah.
That's something they'll be looking at. And I'm sure that with those three things, really, you'll run a successful business. Looking forward to interacting with you in other spaces, if not this one again.
Yeah.
But there's a lot of information out here that SMEs can plug into to help them on their journey.
And I definitely hope that we can have you again. I mean, we've just barely scratched the surface in terms of this conversation, and we have so much more that we could have gone on. But again, unfortunately for today, that's all the time we have for you. That has been our guest, CPA Elvis Moenga. You can reach out to him on social media in case you need advisory on your accounting challenges. He has that expertise, and he'll be able to take you through that. Now, just to remind you some of the solutions that we have, the aim of these conversations is to make sure that we walk with you across the journey, across your investment, and to help you grow your business. So if you're looking to make payment outside the country, if you're looking to manage to make bulk payment or manage your payroll transactions online, we have GT Bank Gaps. There is a payment solution that allows you to use technology to do all these things at the comfort of your home, at the comfort of your house, and we take that headache away. You don't need to come to a branch to make these payment solutions. This is what you need to have. If you're looking for financing, if you're an SME, MSME, micro, small, medium enterprise, and you are looking for a way to just ensure that you have working capital, GT Mazao is the product for you. It's one of those solutions that you definitely need as an SME operating in this economy. Again, as you've had previously, and as you can experience currently in this economic environment, the macros are a bit jittery. There's a lot of volatility in that space. Overhead costs are rising depending on the business that you're in. So if you need quick cash for working capital, again, we got you covered. And also, we have invoice discounting. I mean, we give you upwards of 70% on those of the invoice value, 70, 80%, depending on how much. So please do not do that business just because you're a bit short on cash. Come to us. We'll definitely give you that money and ensure that you continue doing your business. We'll give you very friendly terms to make sure that we work with you, because your success is definitely our success on the other hand. And for those who are in business and you have inventory that you need covered and you don't have that cash, we want to take that burden away from you and ensure that your business is insured by giving you insurance premium financing. It takes that burden away from you. It helps you preserve that capital and that cash flow, making sure that these unnecessary headaches can be taken away from you by giving you enough time. Instead of paying 100,000, 200,000 at once or all once at a go, we give you time to just be able to plan your finances and ensure that once that payment comes, then you can come sort us. And that's all the time we have for you on GT Conversations KE. My name is Jimmy Mbogo. I've been your host, and I definitely look forward. It is sad that we have to leave, but unfortunately we have to bring this conversation to the end. Definitely looking forward to having you on the next one and the next one. If you have any challenges, we've given you all the contacts on the screen. Reach out to GT Bank staff. They will be able to work with you. Whatever solutions that you need, they will be giving you those advice and just getting someone to hold your hand and walk with you through your business and just making sure that your business grows. A very warm thank you to our CPA, Bwana Elvis. Thank you so much for making time to be here with us. A big thank you to the entire team behind the scenes from CH Studios, GT Bank themselves, and to all of you for making time to be here and to follow this conversation and take part in this conversation. We wouldn't be here if it weren't for you. So thank you, and definitely looking forward to having this conversation again. At Jim Cario is where you can find me. And until next time, do have a wonderful, wonderful week ahead.